All right, welcome back to Investing Wizards. I am here with Steve Strazza, technical analyst and head of US Equities at All Star Charts. And Steve is actually my second guest from All Star Charts, where we had JC, who was our first guest on Investing Wizards. But enough about JC and more about Steve. Steve, welcome to the show.
Thanks for having me, Rob.
So I'm excited about the conversation today. There's going to be a lot of stuff we have to talk about that's going on in the markets. Wanted to start off by giving people a background about what you do. Obviously, you work at All Star Charts, which is a technical analysis firm, but you have a fundamental accounting background. So can you just walk people through kind of how you got into investing and how you shifted from this fundamental mindset to this technical mindset?
Yeah, it was a cool journey getting to where I am now because, like you said, I went to school as an accountant, took my first job working at one of the big fours as an accountant, auditing Wall Street brokers and dealers, and kind of learning about the securities industry and the asset management industry from a fundamental perspective. So when I started work, I was auditing financial instruments line items for balance sheets for big brokers and dealers. And that's how I kind of found a passion for markets, and I learned about derivatives and how they work from an accounting perspective. From there, I went and I worked again as an accountant, but in the asset management industry for a number of large hedge funds. But I was always still on the accounting side, but still doing the accounting for the instruments that they were trading. So that's where I developed a passion for trading. And when I kind of moved on and realized I wanted to move away from an accounting career and move into something more to do with, I wanted to get out of the back office and into the front office, more or less. So I wanted to develop my skills more. And I went off and started trading on my own and just kind of learning, and kind of took a year or two off and kind of tried to figure out what I was doing. And I was trading and investing a lot. And I was using a financial statement analysis approach and what I had learned about fundamentals. And the problem with that is I found out the hard way that as a fundamental analyst, when the stock price of something you like goes lower and nothing changes about the financials, it's only more attractive. So you only want to buy more of it. And I had no risk management process in place. So I would buy a stock. For example, SunEdison was one that I liked a lot back in the day, and I know a lot of people remember that. It was popular amongst the hedge funds. And it kept breaking down and breaking down and breaking down. And I rode the whole thing lower, bought more and more the whole way down, all the way to zero. And then it turns out, it went to zero, but then they drop a press release. Oh, we've been lying about our cash for the past year. Or it was earmarked for projects or something like that. It wasn't free cash. And they were listing it as free cash. It changes everything. So then I learned that a lot of times when you take the fundamental approach and only the fundamental approach, you can kind of get caught in these situations because your starting point is you have to rely on the numbers that you're working with. And if there's any type of fraud or even just creative accounting, I call it, going on, you can really be misled and you think you're in something that's a good opportunity when it's not. And I would say, like, just as a recent example for people, General Electric. At that point, I was using technical analysis, thank goodness, but that's a stock that, as it was falling off a cliff from the 20s into the teens and then lower and lower, the stock only looked better and better from a valuation standpoint. Then I think a year or a year and a half later, they restate their earnings, and it turns out they made half the amount of money that you thought they did, which means that their multiple was double what it was, right, the whole time. So if you don't have some sort of risk management process in place, you could be the best fundamental analyst ever, but if you get mixed up with the wrong stock or the wrong company and you can't trust their financials, the whole starting point for your discounted cash flow model or whatever you're doing is flawed. And that it's not your fault. There's nothing you could do with it. Something with GE, I don't care how much I would have liked the stock fundamentally, when it started breaking down below these key risk levels, I mean, that's just a sign to get out. Because if people are selling it, typically they know something I don't. And I learned that the hard way. And I'll find out later. But that's just kind of how I found it and fell into it. And then the more I learned about it, it was never really my goal to say, okay, I'm just going to forget financial statement analysis altogether. And I never have, and I never will. I love it. It's just a part of me. But the more I learned about technical analysis, it's just that it's simpler, it's easier. Um, it's a lot more adaptable. So for example, I used to invest a lot in the broker dealer space, and who wants to be buying financials these days? But that's what I knew as an analyst. So I knew I could look in their books and, kind of figure things out. And that was my bread and butter. But at the same time, it was hard for me to take what I knew and apply it to maybe a retail business or something more niche, like oil and gas producer or something different. I would have had no idea what to do with those financial statements because that wasn't really my forte. With technical analysis, what's beautiful is that as long as the asset is traded and has prices publicly available, we can perform the same analysis using the same approach on anything. It doesn't matter if it's cryptocurrency, soybean futures, European stocks, bonds, anything. So it just became my whole universe kind of expanded, and that's one of the things I liked about it most. But the way I invest today is I'll typically use fundamental analysis or financial statement analysis just as like a way top filter at the top. So the stocks that I'm buying or even looking at technicals for, I'm already comfortable with. I usually try to stick with quality stocks. Every now and then, we'll look at other things, but it'll be for shorter term trades and our risk will be well defined and things like that. But it really allows me to be a lot more flexible and do a lot more.
Yeah, it's kind of interesting. You mentioned this notion of believing in the financials. When I started on Wall Street, it was kind of right around Enron, and I started in the research department at Goldman. And I remember the analyst there would go up and be like, Enron is trading at 4 times. It's the cheapest stock in the market. And then these traders, these smart traders would be like, yeah, 4 times bullshit earnings. And I'd be like, what does that mean? What is bullshit earnings? And then, you were later on, I guess you found out what that means. So, and then I guess most recently you had this very glaring example with Wirecard, with it being cheap and the company saying their fundamentals and their cash position was so good. And if you look at the chart 3 years ago, it started telling you something is not right.
And that's the same story with GE, right? I mean, nobody knew what was going on then, but that stock was breaking down long before anybody knew what was going on.
Yeah.
So price will always, there's always somebody with more information. And if you can just follow the money, it's usually, like you said, you'll find out afterwards. Hindsight's always 20/20, but price will always tell you beforehand. And that's something like we talked about with fundamentals that, sometimes you can make great investments off fundamentals, but you have to take that huge leap of faith that your starting point and the numbers you're looking at are right.
Yeah.
Which I was an auditor, so I know that's not always the case. And I'd been on, like you're talking about Enron. I remember working on a client. They were a very big market maker. I think they were one of the biggest treasury market makers at the time. And I'll never forget, it was October 31st, Halloween. They went bankrupt and whole big to do. So these things happen even to the biggest firms. So you gotta look at the charts and see where the money's going to kind of really make sure that you don't kind of get caught on the wrong side of one of these companies.
Yeah, absolutely. And then talk to us about your investment process at All Star Charts. So I think All Star Charts produces some of the best research out there. I follow you guys on Twitter, and I get your emails. And since I've been following All Star Charts for the past 3 or 4 years, you guys have nailed every single market turn, which is pretty incredible. Talk to me about kind of like the process of you identifying ideas at All Star Charts, and specific ideas. Like you put out Yandex recently as a stock that technically had a very bullish setup. How do you find ideas? Do you flip through charts? Do you have some kind of quantitative approach? How does that work?
First of all, thank you. I guess we've just gotten lucky for like 3 years, but no, we're very proud of the way that we've maneuvered the market. It's not been easy, but even in March, we were buying things. We created a coronavirus index. We kind of caught the turn there. What we really do is we focus on different things at different times. But what it all boils down to is our process is that we're looking at more charts than anybody. That's what we like to think or strive for, right? We're looking at thousands of charts a week between all of our analysts each. So you add that up, we're looking at about 5,000 charts a week each. And we get on the phone and we say, here's what I'm seeing, here's what I'm seeing. And then we take a weight of the evidence approach. And then when it comes to picking, trade ideas, we just take a top-down approach. So we'll go from this huge macro view, and that's always where we start. We zoom out, we look at the indexes, we look at what's going on with currencies, and everything kind of plays in. So we have a huge emphasis on intermarket relationships and intermarket analysis. And we're also careful not to take that too far. You never want to take an intermarket concept to like the fifth derivative and be like, oh, if copper's outperforming gold, then rates must go higher, so I should short bonds. No, if copper's outperforming, just buy copper sometimes. That's the easiest way. So while we do, use intermarket principles a lot to kind of build a big macro view, we're also very careful and are very cautious to always go back to price and say, all right, if the price of this is going up, like we'll talk about in a little bit, right now we're in a weird environment. Bonds are higher, stocks are higher, commodities are higher. And it's just kind of like, well, one of these has to give. Well, the way we look at that, rather than trying to make a bet on which one has to give, is if your risk is clearly defined, and a lot of these bond funds, it is right now. I know a 10-year note just broke out. If you look at something like TLT, it's about to break out. AG just broke out, the aggregate bond fund. If your risk is well defined and prices are moving higher, it's an uptrend. You buy it, it's innocent until proven guilty. If we're wrong, your downside is very limited. Okay. Same with commodities. If copper's going to break out, make a new 52-week high, get long. If we're wrong, your risk is so limited. Same with stocks. They continue to break out across the board. There's a new stock every day. And it's not even just tech anymore. It's everywhere. I was looking at John Deere today. And that's like you said about Yandex. The way that we'll find individual trade ideas is we'll start with an index. Or right now, we just like US Equities. And we're noticing that, large caps may be starting to cool off, whatever it might be. So yesterday I was looking at industrials. And I said, okay, I really like the equal weight industrial, RGI, ETF. I liked what I was seeing there. I liked it on a relative basis. And I said, okay, now how are we going to play this? Then I dig into the industrial components. And a lot of times I'll go to the industry groups first. I'll say within industrials, is it the railroads? Is it the truckers? I know it's not the airlines, but who's driving this strength? And I found John Deere from drilling down into different industry groups, and they just made a new 52-week high, broke out of a beautiful big base, exactly the kind of setup we like, exactly what I'm talking about. If you look at Deere right now, if we're wrong on that stock, maybe there's 2 points of downside. If we're right, I think there's 30, 40 points of upside. So that's kind of our approach. Your risk is limited. You got a nice breakout. Just put the trade on. If we're wrong, we're wrong.
Got it. So you basically peel back the onion. You start high level, sort of say, where am I in the big asset classes, equities, bonds, commodities.
Sure.
If equities look good, let me look into equities. Let me look into the sectors.
And that's the key point you made. At first, it's like, okay, do we want to be buying equities?
Right.
That's where it starts, and then you drill down
and then I guess the other interesting thing is this concept, which is like such a basic concept that so many people get wrong, is go fishing where the fish are. And I probably need to explain that a little more than just giving a cliche like that. Whenever I find that novice investors, they'll be like, oh, it's a bull market, but I'm trying to find stuff to short. And it's just like, no, if it's a bull market, find stuff to buy. And if industrials are doing well, find industrials to buy. And if, like you said, if ags are doing well, find ags to buy. Don't go looking at something that's not performing well or that doesn't have the momentum behind it.
That's it. And I mean, that's why we have gotten obnoxious. It's to the point where I'll be like, JC, I can't write another post about semiconductors. I'll be like, he said to me one time, he goes, that's information. Right. The fact that you think you're writing too much about semiconductors, you're obviously seeing something that's bullish enough that you should probably keep writing about semiconductors.
Yeah.
And he was right, because that was like 2 months ago.
And then AMD goes up by 100%.
Yeah. And that's a name that, I mean, if you zoom out on a chart like AMD, just like I was talking about Yandex, my favorite setup technically is just a giant base. Yeah. Because you have that pent up demand. And when that thing finally rips, we don't say the bigger the base, the higher in space as a joke. That's not just something that's cool because it rhymes. No, there's a lot of things at play that go into that from a supply and demand perspective. It's that If you're testing the same level over and over and over and over again for 2 decades, like AMD was, and you just can't get through, there's a lot of sellers there. And every time you test that level, you absorb a little more, you absorb a little more, you absorb a little more. And then when prices finally go, people really usually underestimate the legs that these breakouts can have. AMD is a great example right now. When that base went, I mean, look at the stock now. Yandex, I think I just tweeted about, after it broke out of that, 5-year base, it's been up for the past 6 or 7 straight weeks, about 30%. So when you get a nice base breakout, it goes back to what I was saying. You know where your risk is, so you know where you're wrong. And if you can get in right at the breakout, I mean, your risk is incredibly limited. Yes, you want to be careful about whipsaws. And the way we deal with that is, I don't care. I don't care if I buy and sell something 5 times. If there's a false start and a whipsaw lower and then it rips higher again, I'll buy it, I'll sell it, I'll buy it back. And I'll keep doing it until it picks a direction. And because when it does and it finally goes, you know, you're probably going to make up for whatever you lost getting there.
Yeah, and that's I've tweeted out, and that's my favorite technical setup as well, is a long base or consolidation and then a breakout above a very clear point where the market couldn't get above it, and all of a sudden does, whether it's a catalyst or not, because that really sets the stage for a really big run up. So AMD recently, Square
Square is a good one.
Square had a similar setup. Actually, one this week that had a setup like that sort of failed, like you talked about, is Morningstar. Why don't we actually share the screen and start and some charts, because this would make it easier. So let me just share my screen. Morningstar was interesting because there's so many data companies like S&P and MSCI that are making that are making new highs, that have been doing so well. With Morningstar, it had this kind of like very long kind of like consolidation base, almost like a cup and handle, broke out here on earnings, and then came back down here. So kind of like, I guess according to your methodology, you would buy this here at some point, either here or down here. You would stop yourself out.
Yeah, I'd be out real close to that risk level. I'd probably look at, like, just to give, I always like to give some space. I'd probably look at like these highs here.
Yep.
You know, and then I'd be out. And like I said, that could be a failed breakout, right? So you could even short it too. And literally, there's nothing wrong with being long on the breakout and then saying, oh, nope, it was a failed move, and then shorting the same stock. I mean, a lot of these failed breakouts can turn into really fast moves lower. And depending on what vehicles you're using to trade them, you can pick up some nice gains there.
Yeah. Okay, so let's and by the way, the other what is it, S&P, I think SPGI,
and so, MSCI has been
MSCI, another, well, they do more kind of like index license and data and stuff like that, but two monster charts in terms of data providing to the financial services industry. And that was kind of like my, hey, this technical event happened. Just going to put this on a new chart. This technical event happened in Morningstar from this kind of like very strong resistance level. Yeah. I thought maybe it's going to be following these stocks, but right now it's a little bit of a unclear picture.
And that's something that you have to take into consideration too. Like what you're basically speaking to is a way to the evidence approach, right? So the way we'll look at stuff like this is, all right, if all of your competitors are breaking out and resolving higher, and you're in the same business, like, for example, say the banks or the airline, well, say the banks, if JP Morgan's breaking out, Bank of America's breaking out, Citi's breaking out, then, well, Wells Fargo, do I want to bet against it? Probably not. So like you said, that's the right way to look at it. That's the way that we'll look at things too, no matter what the universe is, whether it's on a more micro level or a more macro level. From an index perspective, NASDAQ is higher, semis are higher, tech is higher. All right, discretionary is probably going to resolve higher. Communications will probably resolve higher. Healthcare, who's next?
Yeah.
So I wouldn't. This is the kind of stock where I would be very cautious to short it, just because of the industry group that it's associated with.
Got it. Okay, so this would actually be a pretty good entry level for kind of people who didn't get in here. All right, so let me. I know you have some themes that you wanted to talk about. Tell me about the first theme that you're thinking of.
So starting in July and really, going back over the trailing quarter, the dollar has been very weak relative not just the G10 currencies, but also a lot of emerging market currencies. And a lot of what we're seeing, a lot of the performance trends that we've seen, especially starting in July, with commodities higher, um, international ETFs higher, stocks higher across the board. A lot of that is kind of being driven by a weak dollar. So that's something that, you never want to underestimate the power of King Dollar. We ran performance like scatter plot for our monthly preview. And basically what we showed is anything denominated in dollars and, even bonds, they're all higher. They're all trading near 52-week highs. And then you have the dollar down like 5% over the trailing month, down like 4%. So, that has a lot of implications when the dollar kind of collapses the way it has, because it's done nothing. It's been a snooze fest for a couple of years now. So,
Yeah. So the dollar is obviously, or the dollar. You could look at the dollar versus a bunch of different currencies.
yeah,
You can't just look at it versus one currency. So I think the index that everyone looks at is, let me just pull this up here, is the Dixie. And the Dixie is actually, I believe it's like 60% euro.
Yeah, it is.
Is kind of like the composition. And so this is going to be heavily weighted with some of the G7 currencies, particularly the euro, but then I think Canada and the British pound and stuff like that. And if we look at the long-term trend here, what are you seeing here?
Thing's a mess.
Yeah.
It's a mess. I mean, I see lower highs and lower lows.
Yeah.
So,
so I love that. So that's the other thing about technical analysis is sometimes there is no trend. And so the trend here is I totally with you, sideways, and it's pretty well defined between 70 and call it kind of like 150.
Yeah.
But you do have this kind of like cyclicality where it's like rising here, down here, rising here, down here. It's been rising for the past 10 years. And it does feel like this is similar to kind of these peaks where it sort of wants to roll over.
Yeah. And you know what else I would say? Even though that's a sideways mess, it has a downward bias, right? Where every major peak and trough is lower.
Yep.
And that means that, if you look at that chart, I know that we just made a fast move after breaking below 96 to 92, and that's a lot for the dollar index. But when you zoom out like this, it really can show people the bigger pictures. There could be a lot further downside. So you really need to be aware of, kind of what this dollar weakness and how that dollar weakness can reverberate through other asset classes and impact them.
Right. And even though it's felt like a big dollar move because everyone's talking about it, and now you're getting a lot of people saying sentiment is max bearish dollar.
Right.
If you look at the grand scheme of things, it's barely moved. And so if it sort of comes down to this $80 level, which, is historically is kind of like, okay, that wouldn't be extreme at all. That's still a lot of downside from here.
That would have a major impact across asset classes. And that's something that people need to be aware of. Because like you said, if you were to zoom in on this, it's still kind of trading in that same range it's been trading in since, 2015, 2014?
Yeah.
Right? It's still kind of – so if we take out that 2018 low, then, I mean, look out.
Right. So till down here.
You could draw a nice horizontal resistance at the 18 low that'll match up with the 09 and I think 10 highs.
Kind of here?
Yeah.
Yeah. So, right. So this is kind of a pivot point.
That's what we're looking for. That's what we're targeting right now.
So I got it. So that's so from here, another kind of 4%.
Yeah. And 4% is a lot for this index. So.
Right. And then going back here to the currencies, just looking at whether it's this matrix. So this would be the long pair, and this is the short pair.
That front row tells the whole story that we're talking about.
Front row, which is long dollar versus short all these currencies over the past 3 months, over the past 1 month.
Yep.
Year to date is probably a little more mixed because this trend really started in March, April when the Fed started doing QE, and in July when it committed to doing infinite QE until things improve. That's really kind of like this sea of red is really what you're talking about here. And
Yep.
then in this table, looking at the 1 month performance, you have to be sort of careful here. So here the major crosses are first. So meaning the euro here is up over the past month. The pound is up. But if you
And
look
then
at it,
look at the EM currencies too. I mean, this is not, like you said, it's not just the majors. The dollar's really starting to break down against a lot of EM currencies, which it had been doing better against them. But
right. So like over the past 3 months,
yeah,
the dollar has really weakened against all these different EM currencies.
yeah,
And that brings up an interesting dynamic of what's going on in EM and the performance of different EM countries.
yeah.
So
Yep.
if we look at kind of like the world, let's look at the world equity indices, which
Yeah.
is just kind of like the equity indices. I'm just going to pull up the 1 month and 3 month numbers here. And by the way, quick little tutorial, you could change the column headings up on here. This little button over here is where you choose your columns. So let me choose that. And over the past 1 month and 3 month, things are sort of like up, but they're mixed. You definitely get a little more red across the board.
Europe's been a little weak. Like if you look at the FTSE, and yeah,
Europe's been weak, but if you look at the country ETFs,
because of the euro strength, it's a much different story.
because of the dollar weakness or the strength, it's a different story.
Yep.
So if I pull up the 1 month and the 3 month numbers here, let's put that here. It looks like a much different story because everything is green now because of the dollar weakness. And so
Right.
when you're buying the ETF that's dollar denominated, any strength in the EM currency or the foreign currency, you're benefiting from.
And that's something a lot of investors don't know, but it's so important because a lot of investors trade these international ETFs, right, as vehicles. You're not just betting on, if you're buying EWG, you're not just betting on the DAX going higher, but you're also betting on the euro, right?
Right.
So a lot of people don't recognize that there's a currency component. It's not just the equity component. And
Right.
yes, it should be a lot less volatile, but what a lot of these EM currencies could move pretty quickly. I know we were talking about Turkey off air, and when they do, you'll see that reflected in the ETF.
Right. So if we pull up the Turkey ETF here, just going to make this smaller, and then I pull up TRY US dollar, and then I'm just going to turn the group off here. You could see here that over the past 5 years, 10 years, whatever it is, they are very correlated because the Turkey ETF incorporates this exchange rate. And
yeah, especially look at that dunk lower the past few days. Yeah,
the past 2 days, the currency has really sold off, and that's caused the ETF to sell off as well. Yeah.
And
so
I think, I mean, there's so many implications here too, Rob, just to, put our fundamental hats back on. A lot of people are like, well, and even, we've questioned this internally. Is it time for mega caps to kind of stop outperforming? Is it time that we see some rotation in the small and mid caps? Well, a weaker dollar is phenomenal for these mega cap companies that do a lot of sales overseas. They
Right.
love a weaker dollar. In fact, when the dollar's too strong, you start to see all this funky accounting where they adjust their earnings for a constant currency basis, which it's something that drives me crazy. When the dollar's weak, simply if they're making sales in China, they're converting them and getting more dollars for the same amount of Chinese sales. And a lot of people don't recognize that trend. So even the trend in mega cap strength is impacted by a weak dollar. While if you look at something like small caps, they'd probably prefer a stronger dollar.
Right. And something like 45% of earnings of large cap names is outside the US, and it's only like 20% of small cap names. And so if you're generating revenue outside the US and that currency is strengthening, you're obviously getting a benefit.
Yeah.
Yeah, absolutely. Cool. So this dollar thing. And then I think the other thing I think you guys have highlighted is just EEM. If we, let me just pull up EEM separately.
And commodities too. They go right in with the EEM thesis and also the weak dollar.
So let me just pull up EEM here as another chart.
Yep. that relative ratio is something that is really interesting us right now, and we have our eyes on very closely, because if you zoom way out on it, you'll see it's right at its lows, and that could be, yeah, zoom out.
So,
Yeah, it's right at its inception lows from the ETF. So if that's a little failed move lower, and we could start to carve out a bottom, we could be in a world where we start to see, emerging markets, and I would say just ex-US equities start to outperform finally, because it's been a decade-long trend of outperformance for the US, and anybody with a home country bias has been served very well, but that kind of trend can't persist forever.
yeah, and so this is obviously a very well-pronounced trend that's lasted, like you said, 10 years.
Yep.
And you can't get too bullish here because this trend has been so
Right.
strong for so long, but very kind of like interesting pickup in strength.
Yeah.
Hasn't really broken the downtrend, but definitely, like you said, worth watching here.
Yeah, we're kind of asking ourselves, like, bottoming is a process, not an event, right? And we're saying, are we starting to see the beginning of this bottoming process? Because, like you said, a 10-year trend isn't just going to reverse overnight.
Yeah.
But we want to watch this and see if it can start to build a constructive base, EM against SPY. Then, yeah, we think there's something there, and we think that would make sense in an environment where you see all these commodities, base metals, risk-on currencies starting to work. So,
and this EM off the bottom, like, this is just a picture perfect uptrend with very few pullbacks, and so it hasn't really. It just kind of like goes higher and higher and higher.
Look at how constructive each consolidation along the way was.
Right. This is like picture perfect uptrend right here.
Yeah. And if you look at other, international ETFs, we do this on a weekly basis. We have a watch list of about 60 international ETFs, and we'll go through every single one. And that's what we're seeing in the majority of them. Yes, there are some really ugly ones out there, like Turkey, which we just talked about. But on balance, I think we measure a bullish momentum regime by whether or not RSI was last above 70 or below 30. And I think 80% of our international ETF list is in a bullish momentum regime. So it's kind of just stuff like that, kind of can paint a pretty strong picture. So for global equities, at least denominated in dollars, things look very good right now. And the global indexes, like you pointed out, they look pretty good. Europe is struggling, but areas in Asia have been very strong over the trailing month and quarter.
Right. So is there? So I know I looked at like South Korea, EWY. EWY has been very, very strong and leading EM. Any other countries that you would highlight in EM particularly?
Look at I would say Taiwan, but they have a semiconductor component.
Right, Taiwan is like 60%.
Yeah, because it's all Taiwan semi.
If we look at the holdings here, Taiwan semi is a third of the index, and then you have all these other mostly semi-cap companies that are components of the index.
It's like one giant semiconductor.
Right.
But no, there's even parts of Europe. Switzerland has been strong, EWL. Denmark has been strong, EDEN.
Got it. Interesting. Cool. Okay, so dollar weakness, international strength. That's a theme that looks like it's going to continue for a long time. Has scope to continue for a long time.
Yeah.
What else? What else are you seeing?
When we look at US equities, we recently did our Q3 playbook, and we kind of just posed the question to ourselves, like, what would we short in this market? What would we short? Because we're still kind of trying to say, is everything going to resolve higher? Do we rip from here? Do we need some more consolidation? Like, what's going to happen? And when we really looked under the hood, and we started with just the large cap sector spiders, because that's where the strength has been, right, with U.S. large caps. And even looking at the weakest areas, whether you're looking at XLE, which is the energy spider, or even you can look at subsectors within energy like OIH, which is the oil services, or XOP, which is the exploration and production ETF. They're all above our risk levels. So, one of our analysts, Tom Bruni, made a great point on the call, and he just kind of said, not up doesn't equal down, and not down at the same time doesn't equal up. But something can't go sideways forever. So if it's not going up, it's not automatically bearish. It doesn't mean it's going down. And that's kind of what industrials, financials, and energy have been doing for a while. They've just kind of been grinding right above our risk levels. And the fact that bears have had such a long time to kind of just bury these things, these weakest areas of the market, and just can't do it, I can only view that as a positive and a bullish development. And then when you look at the rest of the sectors, the leaders, whether it's discretionary, communications, healthcare, technology, you even have materials, took a shot at a new 52-week high recently. When you look around and everything else is breaking out to fresh highs, then you have to kind of say to yourself, all right, it's only a matter of time before industrials, energy, financials pick it up. And you're already seeing it from industrials. And I would think energy and financials will likely follow.
So this is kind of like, so observing that kind of table performance, energy, one of the weakest sectors out there, bounced off the low. It's trading sideways. There's nothing here that you would jump up and down and be like, oh my God, this is so bearish. It's consolidating after a move higher.
I think that's the best example we could find. Like, you can't short that. I would even move that horizontal line up to the top of gap support. Yeah, up to the top of that candle. And, there was a little maybe kind of failed move, a little whipsaw move lower, right there in July. And now it's right back above. It tested it again. So if it's above that 35 level, I see no reason why you want to bet against that, considering within the broader context of the bull market that we're in and how everything else is working so well.
Right. And then XLF would be kind of like another sector that's not particularly strong. And like, if I didn't know what this sector did and had no idea, I would say this is like a bounce off and now consolidation.
Yeah.
This is definitely a more bullish chart than a bearish chart. Although obviously if it was had better momentum, it'd be even more bullish, but nothing bearish about this chart.
And then look at industrials as an example of where we think, financials or energy could go. So there you go. It's already starting to pop off that little sideways consolidation over the past few weeks.
And if we look at if we go through this exercise and look at single stock names, there's not we know airlines are not doing well. No one's flying and all the other stuff.
But even them, look at that. Like, I couldn't short that here.
Right. So again, this is United Airlines kind of carves out this bottom here, pops, and now just consolidating here and arguably breaking out of this triangle consolidation.
Yeah, pull up the Jets ETF. That gives a decent look at all of them. So again, you could draw a little line by the highs of April and May, and price is just kind of grinding right along them. Nope. Yep. Yeah. Right.
Kind of here, right?
Yeah. Right around there. Yeah. I mean, again, like nothing's going to be perfect, which is why we always say, like, we draw our trend lines, and we love horizontal support and resistance. I'm not going to draw diagonal lines all over my charts. Just I can't do it. But you're gonna see these little whipsaw moves lower, right? Like we just saw in August. Like, you're gonna get that. That's gonna happen, but you can't all of a sudden just say, oh, it broke down. No, you got to see follow through. And look, if you look at the red candles there, we never got follow through once it broke below that 1550 level. So bears have had so many chances to push this thing lower, and they just can't do it. So again, at some point, when do the buyers take control then?
Yeah.
If the bears can't take control, then it can't go sideways forever. If it's not going to go down, eventually it's going to go up. And that's the way we're kind of viewing these from at least in the US equity universe.
And so Jets as an ETF is one where probably the weakest or the biggest laggard, but still not bearish. If we look at some other single names, Simon Property Group, which is the biggest mall owner in the US, kind of very similar pattern.
Yep.
We look at SL Green, which is a big New York office REIT.
Yep.
Very, very similar pattern. Even if we look at a company like GE, which, probably one of the weakest charts in the market. What are you seeing here?
That's one where I would, if that breaks 6, I would short that.
Right. But so far it's kind of not.
It held it.
It held it.
So that's good information. Again, sellers had another chance. They couldn't do it. And if you look at the April or June kind of failed breakdown there, prices ripped higher off that level.
Uh,
So right there, ripped higher. So now let's see what buyers have in store here. We're starting to see industrials work. So, I'm not, again, just like we talked about, the way that, we view the market is always using a top-down lens. So if we like industrials, we're not kind of going out of our way to look for shorts in that space. Sure, if one is just so glaringly obvious, we'll take it. But if we like industrials as a group, we'd rather be looking at the strongest names like John Deere, like I was mentioning, and expressing our thesis on the long end. Right. But the fact that even the weakest names, are difficult or we have trouble thinking that we should short them, that's great information. The fact that even the laggards are holding up is never a bad thing. So that's like a base within a base right there. Yeah.
So this is kind of like the consolidation that we talked about in the beginning.
Yep.
In terms of, I don't know if this is clearly a resistance level that it couldn't get through several times, and now is getting through. That's a pretty bullish signal here.
Yeah, and then even if you look at that breakdown at the March lows, and you drew a horizontal line at the lows from 2018, that was a nice failed move, and we love it when these breakouts are sparked by failed moves. Yep.
Got it. So this is like in your charts when you and JC kind of go whoops and
exactly. That's the oops.
That's the oops, and you saw that so many not to kind of get into the precious.
They're everywhere in this market.
Everywhere, right?
Yeah.
And
silver's a great one. Yeah, I'm writing a post about that today.
It's kind of like you had this base, it broke it very decisively and came right back up. And this is obviously where we got 300% net long, right? So that's obviously doing. Oh wow, it's up 7%. That's pretty.
Yeah, and again, dollar weakness. I mean,
dollar weakness.
Big theme here.
And then so like if we talk about silver, and so this is kind of like your style. Obviously, people say, hey, it's extended and it's going up too far too fast. How would you think about like what the potential upside of this is, and like what's like people are scared that this is going to reverse because it's going up so fast. How would you think about sizing and holding an investment like this if we look at the long term? This is a really big move, really fast.
So ready? Here's what I want you to do. Can you draw just a horizontal line at the 2010, 2011 lows? Horizontal resistance. Yep. Boom. So we're there. And now pull up a chart of gold.
Separately or on here?
Yeah, do it on here so that we could show the contrast between the two. And then do the same thing and draw a horizontal line of resistance at those same 2010, 2011 lows. Right?
Kind of here?
Yep. So when gold hit this level last year, yep, we actually told people, there's a lot of dead bodies and overhead supply there at those lows, and that we wanted to be taking profits. And we were I think we wrote a post right about here.
Here, yeah.
No, here. In August.
Oh, got it. Yeah, right where it was kind of, yep.
Yeah, because again, just like I was saying about horizontal resistance, because you're gonna have whipsaw moves. We always try and say we like to draw our trend lines with crayons, not pencils. Make them nice and fat, because things aren't gonna come and test to the penny or the dollar. If it's close enough, it's often a retest or whatever. So we said at that point, gold has some overhead supply to work through. This is gonna take some time. Then you saw the false start that we had early in 2020, and then that hard whipsaw move lower in March. So this was no walk in the park for gold to get through the same level that silver just now is approaching. So we would anticipate that, there might be some churn here. It took from August 2019 to about April of 2020. So what's that? Almost, 8 months for gold to finally work through that overhead supply. And we think that, to see something similar from silver here would make a lot of sense. Yes, it could have cut above that level and then, break down and have a false start and a whipsaw just like gold did. Definitely. But this would make sense in the context of a market where, gold is extended. Silver, if you zoom out on the chart, I was looking at it this morning. I can't say it's the highest in history, but it's the highest in a very long time. If you look at the quarterly rate of change, like the 63-day rate of change on silver, it's at nosebleed levels. It's near its highest level ever. So do you really want to be adding to something at, with that as your backdrop? No, we want to let something like this kind of cool off. The primary trend is now higher, and we think it will eventually follow gold to new all-time highs, but it's going to need some time to digest these gains. And we would expect to see, some chop for the next maybe 3 to 6 months before it does resume higher, just like gold did.
Right. Right.
That's kind of our playbook. What gold did, we would expect to see something similar from silver. And yeah, just you see that rate of change? I just
that's
blew out.
And the last time I got that
exactly
2011 when kind of had this massive spike, and this was actually what's interesting about this run up in 2009, 2010, 2011 is it was trending for so long, and this was kind of the blow off top.
Yep.
Whereas here it's kind of like coming off a bottom, which is
and to be clear, like I know that I'm saying, be cautious here, but what you're seeing there, that is not bearish at all. That's incredibly bullish. That's a momentum thrust for sure. And it's usually going to signal the beginning of a new uptrend. Yeah. But at the same time, this is a long-term trend, just like we've been talking about with gold. This is something that's going to play out over several years, we think. And so for silver to take, a while to get back to its all-time highs, we think would make a lot of sense too. Again, this thing peaked in 2011 and has gone nowhere, but kind of build out a bottom for the past 6, 7, 8 years. So it's gonna take some time. I think you've seen the easy money's been made. Now you kind of want to pick your spots, be a little bit more tactical, buy weakness, stuff like that going forward. But if silver went sideways for the next 3 months, it wouldn't shock me.
Right. Okay. Cool. So I think you wanted to one last thing you want to talk about is kind of the yield curve and banks and stuff like that.
I think it plays into so one thing that a lot of people are struggling with right now is, is it inflation? Is it disinflation? Is it stagflation? I don't care what inflation it is, and it frankly doesn't matter to me. Bonds are making new all-time highs. Stocks are making new all-time highs. A lot of commodities are at least making new 52-week highs. So everything seems to be working. And yes, that's a little bit unusual. And at a certain point, we would expect something to give, right? I can't imagine that base metals are just going to keep ripping in an environment where the 5 and 10 year are breaking the fresh all-time lows. But we don't know which it's going to be. So if you look at something like TLT, the way we would view that, or even IEI or IEF are probably better examples because they don't have that big ugly stick from March or whenever that was. But you can see, they're just resolving higher. Your risk is very well defined there. If you're wrong, you're not going to lose much. If you're right, there should be plenty more upside for a consolidation like that to resolve higher. Typically have some nice legs, just like we saw, heading into 2020 and late 2019, that nice little leg higher there. So we would expect to see something the same. If we're wrong and it fails, we know where we're wrong. Our risk level is right at those prior highs, so we'll be out. But in this environment, we'd be buying stocks, we'd be buying bonds, we'd be buying commodities. And if it turns out that, one of them fails and starts moving to the downside and we figure out and these relationships change, that's fine because our risk is so clearly defined that it doesn't make sense to try and pick who's right, who's wrong, and kind of create this giant intermarket thesis. Prices are going higher, buy it and ride the trend. If you're wrong, you'll know it and you'll be out of it.
I think this is the most confounding thing in the market right now is why are yields going lower if commodity prices are going higher, if equities are going higher. Basically, all these other assets are telling you there's growth and inflation, and bonds are clearly saying that's not the case. And And so if I pull up a chart of 10-year,
Yeah.
which is at 0.5 and CPI at 0.6, basically this is
negative real rates.
Negative real rates. And so if you look at it over the past 10 years, or let's look at it over a longer period of time, typically, but you have this premium where the yield is trading much higher than inflation.
Right.
Recently, that's not the case. So basically, if you're buying a bond today, if you're buying a 10-year bond today, assuming inflation stays where it is, you're making zero money. You're basically
losing money. Yeah.
And so if you're buying a bond today, you're basically assuming that someone is going to buy the bond at a higher price.
Yeah.
Which is
and I think too that like this plays into what we're seeing from financials. They've been a relative laggard, and if you look at the spread on the 10-year, like the tens and threes.
Do you want to look at regionals?
Yeah. Look at regionals.
So if we do regional banks over SPY,
right?
Pull up here, U.S. yield curve, 10-year, 3-month.
And what this is basically doing is, if treasuries are going to break out and keep working higher from here, typically the long end of the curve is going to outperform. So these spreads are only going to be compressed further, right? They're only going to tighten more. And banks, especially the regional banks, and even more so the community banks, which are QABA is the ticker symbol, they're not like the big money center banks where they have, 10 different revenue streams. They make their money off of lending, more or less. And, they pay about, the 3-month yield on their deposits, and then they lend their money out at about, the 10-year. So that's a good barometer for kind of how they're doing. So I think when you're seeing this yield spread, the 10-3s break to its lowest level since Q1 or wherever that was, then to see financials and particularly banks and smaller banks underperform, I think it makes a lot of sense.
This is this kind of like explains everything, right? And kind of
look at that relationship.
In this yield curve environment where the yield curve continues to flatten even after this kind of spike, regional banks don't have any shot of out. I love this chart so much, I'm going to tweet it right now.
You should. That's a fantastic chart, because a lot of people are saying, we can't have a bull market without financials. Well, financials aren't going to go up without banks, and banks aren't going to go up with a yield curve looking like this. And maybe it's just more a story of the fact that bonds are doing well rather than financials are doing that bad. You could find areas within financials, whether it's the brokers, the capital markets firms that we were just looking at, like MSCI and SPGI. You could find areas in financials that are doing very well, fintech firms, but the banks are struggling. And I think that's not necessarily a negative for equities. That has more to do with what we're seeing in credit markets. Right.
And these, the other thing that's interesting about investing that's difficult is things never line up. All the factors never line up and point in the same direction.
Right.
Whether it's one investment or how to think about risk. And right now, the biggest disconnect for me are these bonds and what they're saying, and kind of like this warning sign. But, that's not a reason not to be bullish. It's just kind of very, very strange and something to follow. And only in hindsight will we be able to say, oh, that's why this happened.
Right.
But that's
I couldn't agree more. That's something that internally, we're saying to ourselves, this is odd. How long can this persist for? And the answer is we don't know. So if bonds are breaking out, just like we were talking about before, and your risk is clearly defined, buy bonds. If stocks are breaking out at the same time and your risk is clearly defined, buy stocks too. Same with commodities. Yes, will these relationships eventually give way and we'll see one kind of, catch to the downside? Definitely. And then we'll be out of it and our risk was clearly defined. So we're fine with that. We'll still be in the others that are working.
Got it. Awesome. Cool. I think that's kind of like the big market themes that we wanted to talk about. And this has run pretty long, but I love this conversation. A lot of stuff packed in here. let's sort of finish up here.
Sure.
First, wanna ask you something that I ask all my followers and all my guests, and that everyone's stuck at home. A lot of Netflix and Amazon and Hulu going on. Favorite TV show since the pandemic started that you want to recommend to people, or movie?
I got to be honest, this pandemic has gone on for so long. Even Netflix can't create enough content. I feel like I've seen it all. I'm tired of it. I was on a Scorsese kick recently. I watched his first feature, which had Robert De Niro in it, and it was one of his first roles ever. And De Niro's amazing. It's called Mean Streets. And if you're a Sopranos fan, Richie Aprile plays the main role in it too.
Oh,
And
cool.
Harvey Keitel's in it. And it's kind of just like Goodfellas, but like the first iteration of it. So if you're a Goodfellas fan or a Scorsese fan, I really enjoyed that movie. I had no idea it existed, but it was phenomenal. And then what I've been watching, to be honest, because I miss sports so much, is I've been YouTubing old like 1990s basketball games. I think The Last Dance kind of got my basketball fever up. So I'm a big Knicks fan. So I've been watching old like 95, 97 playoff series, Knicks Bulls, Knicks Heat, all the classics on YouTube, and that's been a lot of fun.
That's all. It's kind of funny that sports, even when you know the outcome, is still interesting and fun to watch.
It's almost even better now looking back and being like, wow, the NBA has changed a lot. Those guys used to go at it. If you watch some of those old, and they talked about it in The Last Dance, but if you watch some of those old playoff series, man, those teams hated each other. They were fighting constantly.
Yeah.
Guys would go to the hoop and they would get slaughtered. It's not like it is today.
Right, right. There was like football as well, and I guess basketball and hockey.
Yep.
Different time.
They've all changed. Yeah.
That's awesome. Cool. I'll check out Mean Streets. I haven't seen it, but I thought Raging Bull was kind of the first movie. I didn't realize there was one before that. And then last thing is, how can people follow you on your work and on email and on Twitter and stuff like that?
So pretty much everything that we publish on allstarcharts.com. So that's where you want to go to follow all of our work. Me, Tom Bruni, JC Peretz, Sean McLaughlin. We put out a bunch of content all day, every day. But you can also follow me on Twitter. My handle's @STrazza. That's SSTRAZZA. And pretty much everything that we post or write about, we tweet out. So that's a good way to get it. And then I'm also, just tweeting my ideas throughout the day. So Twitter's really the best place. And obviously the website, allstarcharts.com.
Cool. Awesome. Well, I really enjoyed this conversation. Thanks again for being on. I can't wait to have you on next time.
Yeah, this was a lot of fun, Rob. Thanks for having me.
All right.